Hi, welcome back. As we embark further into the value investing space, I want to talk a little bit about value contrarians, value investing in its contrarian form. In essence, you're going against the grain and hoping to make money off it. So let's set the stage. In contrarian value investing, you begin again with the proposition that investors overreact. Investors overreact to good news, investors overreact to bad news. That makes it very similar to contrarian trading that we talked about in the context of trading. But here's where value investors bring something more to the table. In good contrarian value investing, in addition to looking at what the stock price has done and assuming that investors overreact, you look at the fundamentals to make sure that you're on solid ground, assuming that overreaction is right. There is evidence, of course, that investors overreact. That if you look at, for instance, the serial correlations we talked about, over very long time periods, over 5-year periods, stocks are more likely to reverse themselves than continue on the path they were in. If you focus on individual stocks and markets, you get pretty much the same effect. So let's start this discussion of contrarian value investing by taking what I call the bludgeon approach. The bludgeon approach is in fact contrarian trading. It's not contrarian value investing, but in contrarian trading, what do? You look at stocks that have gone down the most over the last 6 months, the last year, the last 5 years. You buy those stocks and you hold, expecting them to reverse themselves. I talked about the DeBond-Taylor research in an earlier session. DeBond and Taylor created portfolios of 35 stocks which had gone up the most and 35 stocks that had gone down the most over the previous year, and then track what you'd have made as returns over the next 5 years. And the results are pretty astonishing. Over the next 5 years, or the next 60 months, if you bought the loser stocks, you'd have made substantially more returns, almost 30%. Then if you bought the winner stocks, which are actually down 10% relative to the market, look at the difference. Close to 40% difference between the loser stocks, which emerged as the winners, and the winner stocks that became the losers. This was the base. This creates a pretty solid basis for a contrarian investing strategy, right? But not so fast. If you take a closer look at those winner and loser portfolios, here are the things you need to worry about. First is the loser portfolios contain a significant number of really low price stocks, $1.50, $1.80 shares. And as we talked about earlier in the context of trading costs, those low price stocks have much higher trading costs. The study also found that or a follow-up study also found that creating the loser portfolios in December creates much better returns than creating the loser portfolios in June. You're saying, why? There's some interrelationship between this loser effect and what we noted as the January effect, where January is the best month of the year. Many of these loser stocks deliver their highest returns in January. And third, you need a time horizon that allows you to capture those excess returns. The DeBond-Taylor study looked at the 60 months following, but a subsequent study looked at what your returns would be for winner and loser stocks by month of the year, the cumulative returns. And if you look at the first few months, the first 12 months after you create these portfolios, winner stocks continue to win and loser stocks continue to lose. In fact, there's continuation. It's only after the first year that you see the reversal kick in. So if you go into this strategy thinking you're going to make money, you buy the loser stocks and you sell, you get impatient, you sell after 9, 10 or 11 months, you're likely to lose money with this strategy, not make money. So it's a bludgeon strategy because you're basing it on pricing. I'm not sure the word value even belongs in the description of what you do. You're a contrarian trader. Let's dig a little deeper though. Let's suppose you truly want to create a contrarian strategy that's built around value. In this case, you want to invest in stocks that have had a price drop but don't have a drop in fundamentals that justify that price drop. In other words, you're waiting for the stock price to drop, and that stock price drop you then measure against what its fundamentals did and said this stock price drop looks like it's too much. You're most likely to see this version of contrarian investing kick in when stocks overreact to a news announcement, or a market crisis causes a sell-off across the board, good stocks and bad stocks, or an entire sector gets marked down. So in this more refined version of contrarian investing, you're looking at the price and what it does, but it's a starting point. You also look at fundamentals. So understand how this would work. You're effectively looking for good companies that get marked down, right? But what's a good company? I'm going to give you a framework that I found useful in separating good from average to bad companies. I look at 3 dimensions: revenue growth, margins, and reinvestment. The very best companies, great companies, have high revenue growth. They're able to grow fast, but they're able to do so with high margins and relatively little reinvestment. Those are your great firms. At the other end of the spectrum, your terrible firms have low revenue growth, terrible margins, and reinvest a lot to get there. And the generic firm in the middle has revenue growth, margins, and reinvestment that are pretty much in the middle. Great companies are able to grow a lot, are profitable without having to throw in huge amounts of reinvestment to deliver that growth. So you're saying, this is great. I can go out and find all the great companies in the market. It's not that difficult to do. But converting into great returns is much messier, and here's why. If you invest in the very best companies, but you pay prices that reflect the fact that they're very best companies, you're not going to earn returns that reflect the fact that these companies are among the very best. In fact, this is from a very early study that built off the well-read and widely bought book by Tom Peters on excellent versus unexcellent companies, where he identified the characteristics that make for excellent companies. I'm not going to contest that book, but this study actually took that book and said, what would happen to an investor who read that book and went out and put his money into excellent companies? Conversely, what had happened to an investor who read the same book and took a perverse strategy of buying unexcellent companies, companies with the exact opposite characteristics? Well, in the 60 months following, the $100 invested in unexcellent companies would have earned you a lot more money than the $100 invested in excellent companies. Sounds perverse, but it depends on the price you get it. In fact, a follow-up study looked at companies that were ranked based on brand value from best to worst and found that the companies which were ranked the worst had much higher returns, 11.95%, than the companies that were ranked the best. Often when you just invest in good companies, very well-run companies, excellent companies, you're not going to earn the returns that reflect that goodness if the price already reflects it. Investing is a game of mismatches. What I mean by that is you want to buy a good company which the market thinks is not a good company. Conversely, buying a bad company that the market thinks is an awful company might be a great strategy. It's about finding mismatches. So the essence of mismatches, the value of the company reflects how good its business is. The price of the company reflects what the market thinks about the business. So if you think the company is good and the market also thinks it's good, it's a match. You're not going to make much money there. If you think the company is good and the market thinks it's bad, this is a great investment. You go out and buy it. If you think a company is bad and the market perceives it good, this is your overvalued stock. You sell it. And the market thinks it's bad and you also think it's bad, you're indifferent. So there are 2 perspectives at play. Your perspective on a company, is it a good company? And the market's perspective, is it a good company? The market's perspective shows up in the price. Your perspective shows up in your value. You're looking for a mismatch. Now, if you're a screener, there are ways in which you can find this mismatch. But to implement this strategy, here's how you go about it. First, you wait for a trigger. The trigger can be a market announcement that causes the stock price to drop. I'll give you a personal example. In 2021, Facebook/Meta saw its stock price collapse because of a huge fiasco around an investment they made in Metaverse. The earnings report comes out, the Metaverse fiasco is playing out. The stock price collapses, drops by almost 60% from its high for the year. It's an entry point, right? But before I make that entry point, and I went and looked at Facebook's fundamentals. Its fundamental business is an online advertising business, which is really not affected by the Metaverse fiasco. I looked at the fundamentals and I said, this is still a good company with a great business at its core the value of the business has dropped 60%. There's a mismatch here between what the market thinks about the company and what I think about the company. And I did buy Facebook. It had a happy ending. Not all my stories have happy endings, but that's how mismatches play out. Market price collapses, but the fundamentals don't support that collapse. If you stay within the screening universe though, here's how you find mismatches. You find a company that's cheap, has a low pricing multiple, price earnings, price to book, EV to EBITDA, EV to invested capital, but don't have the fundamentals to just, you want a company that is priced as a bad company, but has the characteristics of a good company. So you have low PE ratio, company market thinks it's a bad company. But if this company has high growth and low risk and high payout, you find a good company that is cheap. With price to book, you have a low price to book ratio, but you have high growth and low risk and high return equity, you found a mismatch. Conversely, if you're looking for expensive companies to sell short on, a company that trades at a high price to book, market holds it in high regard, but has low growth, high risk and low return equity, there's a mismatch again. The essence of pricing is looking for mismatches. The pricing multiple tells you what the market thinks about the company. The fundamentals tell you what you should think about the company. And you're looking for a mismatch between what you think about the company and what the market thinks. So if you are going to be a contrarian investor, here are some of the qualities you need to bring to the table. The first is you're often investing in companies where everybody else is down in the company. So you need to have the self-confidence to go against the grain. Second, if you're investing other people's money, you need to have clients or investors who believe in you, because you're going to be picking companies where the response is, what are you doing? Why would you do that? And you should be able to convince them to trust you in making this bet. Third, in the immediate aftermath of buying these companies, things might get worse rather than better. So you need the patience to wait through that. And the stomach for that short-term volatility, because you're going to get more bad news about this company before things turn around, even if you're right about the fundamentals. And as always, and by now this should become a common theme, watch out for transactions costs, watch out for timing issues, because those can all get in the way of execution. Ultimately, to summarize contrarian investing, you're starting with the building blocks of contrarian trading. You're looking for stocks that have dropped a lot, built on the assumption that investors overreact. But in the case, the value part of it is you look at the fundamentals as well to make sure that this price drop is not in fact justified. There are many companies where the prices drop, but they deserve to drop. You're trying to separate the companies that are cheap from the companies that deserve to be cheap. And in this case, the contrarian strategy will often mean you're going against the grain, and you got to have the stomach and the patience to be able to wait it out. I hope you found this session useful, and I thank you very much for listening.